Welcome back. You're still watching Markets at Noon, and let us now talk the fundamentals of the market and understand what should be your portfolio development strategy in the market scenarios at present. For the same, we have with us market expert Alok Agarwal, Head Quant and Fund Manager, Alchemy Capital Management. Alok, good afternoon. Thank you for giving your time to ET Now. Mansi Dave this side. When you joined with us in the last session and was talking about the market sentiments, you categorically did mention to consider the dip as buying opportunity and building portfolio. Now, the market participants who would have understood that idea and advice of yours must have taken the right decisions. Now, as we see all the positive triggers coming in the market, how do you see the current texture at present?
Yeah, hi, Mansi. Good afternoon. Yeah, as you rightly put, a lot of things have happened in the last few weeks and months, and specifically the growth challenges that the India was facing has been handled quite well, especially with the GST rate cuts. Earlier this year, we saw the government taking steps via the direct tax cuts, but the GST cuts, which is more indirect taxes, has a much larger multiplier effect on the overall economy. So we do expect the consumption to get a boost as a combination of the direct tax cuts as well as the indirect tax cuts. The only major issue that the country is facing right now is regarding the India-US deal. And once with that deal goes through and this 50% tariff comes down significantly, that would be both positive on the trade side, the currency side, and more importantly on the flow side as well. So we remain positive, especially the earnings numbers have started coming out well. And with this rate cuts coming through, both in terms of the RBI rate cuts as well as the GST rate cuts, we do expect growth rates to bounce back.
Right. Of course, Fed has now responded for the call of cutting the rates. It's not 50 basis point, but still 25 basis point cut is there, and more expectation is there for the rest of the calendar year. But more importantly, for Indian market, do you think that there will be FIIs flows who will come back to India after this? We have already seen the rally today.
So, if I really put it, this year, FIIs have withdrawn close to $20 billion. And in contrast, the DIIs have put in over $60 billion. The fact that India's valuations have been higher and the growth rates were moderating, that did not really bode well, especially at a time when the trade deal was not going in our favor. But a lot of those things have changed. If you look at the relative performances, in last 1 year, India has underperformed the emerging market index by over 30% and the MSCI World Index by over 25%. This kind of 1 year underperformance we have not seen in the last 15, 20 years. So a lot of those things, a lot of those negatives are already there in the price with the growth rates bouncing back. Even if I look at this Q1 results, the Nifty 500 total aggregate earnings grew by over 10%, and which is the best we have seen in the last 5 quarters. And this is not even factoring in the benefits of the GST rate cuts. So we do expect the growth rates to come back, especially after a year of muted returns. The valuations have come down a little. So India's valuation premium to the world stands at about 9%, whereas longer term average is 15%. So we have come down, then the premium has come down compared to the historical averages. The growth rates are bouncing back and some of the headwinds are giving way to improve the growth numbers. So we do expect the FI numbers also to come back. I think the arm in the short would be as and when we get that trade deal done, that could be the biggest positive news that we can see in the coming future.
Absolutely. That's a great observation coming from you, Alok. Moving ahead, tell us what are the preferred sectors at present, and also if any sectors which you are staying away from?
Yeah, interestingly, guys, at the cusp of major change, the major index heavyweight sectors like oil and gas, IT, FMCG, and to a large extent banking. These 4 sectors are close to 2/3 of the major indices, and these are the ones that are not growing much. Out of these, at least banking has some more leeway of growth as and when the credit growth and the deposit growth starts bouncing back, especially with, again, this consumption boost coming through. We do expect that numbers to come sooner than later. But other 3 sectors are actually struggling for growth. But the sectors that are showing larger growth, some of them are actually not there in the major indices. The likes of consumer discretionary, led by retail as well as autos, a lot of internet and platform-based companies, The consumer discretionary services, the likes of capital markets, the travel, fertilizers, chemicals, and in the industrial space, the defense and power. So these are the segments which are possibly not there in the main indices, but these are the companies and segments that are growing at a good pace and are having a good visibility of growth going forward as well.
All right, Alok, thank you so much for putting things into perspective and sparing time.
Thank you.